Was that drop below 2.4 the bottom? Did we put it in for bond yields?
You know what, to be honest with you, I did not. I missed it, but there's going to be other opportunities. I think those opportunities are actually taking advantage of this steepening of the yield curve that we saw today in both 210s and the 530.
Okay, so, but I'm just curious if you think that whether or not you traded it right at that level, do you think that was as powerful of a move as we're going to get for now? Is that the temporary bottom?
I think the temporary bottom in yields is actually about 233. That's a cycle low. Right now we're seeing duration bounce, rates up into 10 to 30, really on the steepening of the yield curve and really nothing other than that.
Okay. Do you see a reason behind it, or is it just a mean reversion from an epic move that lasted several months?
Yeah, I think, as I mentioned last week, typically overbought scenario, and bonds just needed to bounce, and that's what we're seeing now. But it's really not very impressive relative to the stock market. I mean, 10s are still 75 basis points away from their high. 30s are 55 basis points from their high, and yet the S&P 500 less than 2.5%. So not very impressive, a little bit listless, to be honest with you.
So your point is, if stocks keep jamming towards highs, if they cross through them, at a certain point, the bond bulls are going to have to loosen up a little bit?
At some point. I mean, right now I'm very, very comfortable with the strength in stocks that's really due to the low yields, or at least the low real yields. But at some point that's going to matter. Right now it doesn't seem so, and I think it puts the Fed in a very tough position.
Now, it puts them in a tough position, meaning what? Where if we get a couple more follow-throughs from the decent data we've had this week, I think there's been a lot more focus, Larry, on some of the world data as opposed to our own. I mean, we've been doing all right with some of our numbers, but it's really been about China. And then today, all of a sudden, we get a decent print from the Eurozone. It's like, hey, we haven't seen that in a while.
Yeah, exactly. And we have seen some consistent data starting in China. Eurozone retail sales, Eurozone service PMI, our ISM number, et cetera. So on net, it's been no worse than feared, and I think that's the reaction we've seen in yields. I mean, you'd think that yields should be bouncing a lot higher than they have, and I think it just shows you, just the, I guess, the awkwardness of the market right now, just trying to figure out the next trajectory.
Larry, speaking of risk off, maybe call it that, asset classes, because I think the U.S. dollar has also had kind of a risk off type of tone, especially with the tariff situation. It's been a place to really play that U.S. outperformance. I'm curious what you think in terms of how to, if let's say you think there's going to be better data around the world, let's say you think that the economic situation is going to improve, would you rather be short bonds, or would you rather short the greenback?
Oh boy, I think I'd rather be short bonds, because I do believe that the dollar, especially versus G7 currencies, is the best funding currency, and relative to anything else, it still makes a lot of sense being a high yielding currency, something we haven't seen in a while. So yeah, I'd absolutely rather be short bonds than short the dollar. Yeah.
Okay. Last thing here, as we look at the numbers this week, we're inching closer to employment. Today's ADP was a little bit soft. Are we in for some more volatility, Larry? Is this going to be a fun end to the week here? You're the bond oracle who's been guiding us through it this past year. So tell us what to look for.
Yeah, no, this is the thing. I mean, I'm pondering, I'm questioning why consensus is looking for 179,000 ads. Like, only that ads, given the huge miss in February that was due to weather-related issues. But all that to say, the number would have to be absolutely terrible to really matter to the market at this point. And I'm talking like less than 100, 115, 120,000 ads, almost like a big miss. Other than that, I think it's status quo. The market right now, look at the 2-year yield trading 10 basis points under effective Fed fund rates. I mean, we have a lot of things to worry about. And I don't think the BLS report is one of them unless it's a huge miss.